Hi, I'm Tracy Hanbury. Welcome to episode 5 of UK Property News. This week, we'll be discussing, and Ian will be discussing, the impact of the Renters' Rights Bill on mortgages with Gavin Richardson, who is the Managing Director at MFB, a leading specialist in buy-to-let and commercial property finance. With years of experience helping landlords navigate the mortgage market, Gavin provides expert insight into how the Renters' Rights Bill is set to impact landlord borrowing, lending criteria, and investment strategies. In this episode, we'll be discussing the impact of the Renters' Rights Bill on mortgages, where Ian will be asking Gavin for his expert thoughts and analysis on a range of topics in this area, including 1. Will there be a stricter lender affordability and stress testing? 2. Higher demand for limited company mortgages? 3. What will be the likely impact on mortgage availability and LTV ratios? 4. Changes in rental yields and refinancing options? 5. Long-term property market implications, and addressing the key questions of: could the bill reduce the number of buy-to-let investors, leading to a rental shortage? We will find out. Over to you, Ian.
Thank you, Tracy. With us is Gavin Richardson. Gavin is, of course, Managing Director of MFB Mortgage Finance Brokers. How are you, Gavin?
Very well, Ian. Yourself?
Yeah, very good, thank you. Good to see it. Busy time in this world, of course. Every now and again, we come up with a crazy idea of recording one of these without mentioning the Renters' Rights Bill, and we realise it's a path to futility because you can't ignore it. There's so much to it. You're in a world that touches this area, but there is some good news for those looking at mortgages and financing.
I think everywhere you look under the surface, you can find some.
There's always some. Yeah. Give us the good news firstly.
Well, I think the reality of the Renters' Rights Bill is twofold. One, if you are a professional good landlord, this is a relatively positive environment and shouldn't cause you too many concerns. From the lending perspective and mortgage lenders perspective, nothing really fundamentally changes. The ability to lend and who you lend to and under what criteria, the Renters' Rights Bill doesn't have an impact on that.
Got it. So that's fundamentally the good news.
Yeah.
Because I remember in the lead up to this, and of course it's been a couple of years in the making, hasn't it? The Tories gave it a go. Michael Gove was giving it Billy Big Potatoes on this one, and then he obviously walked the plank to oblivion, as it were. And now we've got Angela Rayner and others. There's always that sense. Obviously, interest rates when you're doing this for a living are different to if you were buying a house just to live in for the first time. There was a sort of bit of a sense that maybe perhaps there'd be a tweak, and it would almost be impossible to get a mortgage if you wanted to buy to let.
I think what impacts mortgage pricing is more than political uncertainty or legislative uncertainty. So whilst the landscape has changed and the political parties have changed and the lending landscape has been impacted by increasing rates and the volatility in the market, how we lend hasn't.
Yeah.
So the Renters' Rights Bill, under whichever guise it's changed or however it's been, from a lending perspective, the criteria hasn't had to change.
So it hasn't got stricter, because again, that was one of those senses, wasn't it? That if you're in a world that is full of new regulations, maybe lenders will get a bit twitchy about that, thinking, "Oh my goodness, this is now a higher risk for us to lend money."
I think the reality is, over the last few years, as the PRA and have professionalised the industry, lenders have got more curious about landlords' portfolios and properties in the background. Stress tests are there for a reason, to protect the landlords, to make sure that the affordability is there. So, the Renters' Rights Bill has helped professionalise the industry. Lenders, I suppose, in one respect, have been one step ahead of that because of PRA guidance in terms of how they lend and what they need to look at and how they underwrite.
Are there lenders that are specific? I mean, many watching this will be fully aware of the rules and what's out there, but there might be some people looking to start into this area of industry. Are there lenders that specifically tailor packages to suit this field?
So there are specialist lenders for buy-to-let.
Yeah.
And there are vanilla sort of high street lenders that will lend on straightforward single unit properties, not to landlords that have got 10 or more properties.
Sure.
So there is a lender for kind of every niche and every sector. So if you're a first-time landlord, there is a lender that will suit you perfectly if it's your first property.
Yeah.
If you're buying your 100th property and your portfolio consists of semi-commercial and holiday lets and everything in between HMOs, there is a lender that will suit you in that respect.
Got it.
Each individual loan comes with its own set of criteria, but what is more critical now is if you own more properties, it's understanding the background portfolio.
Yeah.
And things like their EPC ratings and the stress test of the portfolio and the types of tenants in the properties and things like that.
So owning more, does that put you in a better position with lenders, or does it put you in a more compromising position with lenders?
If you own more and they're all relatively lowly geared and have been running efficiently and there's no issues with them and they're decent properties, then there's probably more work from an underwriting perspective because lenders will want to sense check your portfolio.
Yeah.
So it's not straightforward, and one mortgage in isolation as a portfolio landlord isn't looked in isolation. It's looked in as part of your overall package.
Sure. Isn't there a greater security for lenders, though, if you've got a big old portfolio there?
Well, there is a greater security in terms of you know what you're doing and you're professional, but they're worried about their security.
Of course they are, yeah. What about in terms of types of mortgage? I guess this is the how long is a piece of string, fixed rate, tracker, etc. Is that largely, does that just depend on who you are, what your finances are looking like at the time? Or is there a rule set in stone in your world that you can reveal to us now, Gavin, that it's always the tracker or it's always the fixed rate?
Well, we couldn't give away the dark arts of broking.
Well,
but the reality is you're absolutely right. It's down to the individual circumstances, their attitude to risk and their business plans or personal plans and where they want to be in 2, 3, 5 years' time, what they might want to do with the property. The question we get asked the most is, should I take a 2-year or a 5-year fixed rate?
Yeah.
We're seeing probably, just to come back to that in a second, more people staying on variable rates. But I think that's indicative of 6 months ago, everyone thought that interest rates were going to come tumbling down. And as they were coming off their deals, rather than fix at a 5 rate, thought, well, by 6 months' time, I'll be fixing at 4.
Yeah.
Which I'm afraid isn't the reality. So now the question is a 2 or a 5-year deal more realistic? And the answer to that is, again, like I said, but if you need to be really cautious and really aware of the arrangement fees on these deals.
Yeah.
Because if you're taking out a 2-year deal and it's competitive and it works for you, but the arrangement fee is 3% or 5%, and you take that 5% deal and split it over 2 years and it's 2.5% added on to your mortgage rate, it's potentially not cost effective.
You've not gained anything, right?
No. So in the short way of answering, I can't answer that question because it's absolutely indicative to the personal circumstances. The difference between a 2 and a 5-year rate in pricing is marginal at the moment. There's not much. If you came to me 2.5 years ago, excuse me, the difference between a 2-year rate and a 5-year rate was probably 1.5%.
Sure.
Similar to the difference between a personal mortgage and a mortgage for a limited company was probably 1.5%, 2%.
Yeah.
Now it's marginal. It's notional difference. So actually, it's down to your circumstances. What would you want to do in 2 years' time? Do you think rates are going to come down in 2 years' time and therefore you're prepared to pay a arrangement fee and refinance or do a product transfer and take advantage of a lower rate in 2 years' time? Would you want to tuck it away for 5 years, not worry about it, know it works, know the yield is good, not pay another arrangement fee, move on to the next deal?
Yeah. And like any area of business, it's sort of a roulette wheel moment, isn't there, as to which way you go. But for some, I've spoken to landlords who've said, actually, do you know what? I'll go for the 5-year because it's peace of mind. And for some people, peace of mind is worth more. Even if in 2 years' time somebody says, that could have been 200 quid a month cheaper, but you know where you stand for that 5 years. And for different clients, that will be preferable.
And I think is that 2 years arrangement fee, even if the arrangement fee is 2%, then in another 2 years, so you're 4 years in, it's another arrangement fee. And you add that, compare that to a 5-year deal. I don't think in current climate you're going to make that margin back.
Yeah. Tell us a little bit about specialist mortgages then. There's HMO, holiday lets, that kind of thing. And all of these areas, particularly holiday lets, are all subject to new regulations as well.
Yep.
We knew it wouldn't take them long before they started sniffing around Airbnbs, but they are there. But there are different packages depending on what your kind of portfolio, what your business model is.
Yeah, so holiday lets was really interesting. Obviously, it boomed to the end of COVID, when everyone realised that people didn't want to work from home or liked working from home or realised that different locations and they could take advantage of them. So holiday lets became really popular. They're stressed slightly differently. With some lenders, they're used on the average of the holiday let income over 46 or 48 weeks. So they're slightly different in the way that the affordability calculations are applied. Not all lenders will lend on holiday lets because they are slightly risky, because you're going to change the tenant on a regular basis and therefore there's risk to the property.
Sure.
So they need to be managed well. And the HMOs and the multi-units are more a specialist lender type of product. I suppose they deem that as a more experienced landlord that would take out an HMO, which is something that I always kind of argue with, because if you've got an HMO and you're an inexperienced landlord, but you're managing one property with 6 tenants and you've got that security and safety net that if one tenant isn't paying, you're still making money. But lenders kind of view that it's a specialist product. You need to be experienced, understand the increased legislation and regulations around HMOs and all the things you need to consider. Lenders expect you to be experienced. Pricing's probably slightly higher because of their perceived risk of running those types of property. And from their point of view, it's a slightly riskier lend. But there are vanilla high street lenders that will lend on a very simple sort of 4-bed HMO as well.
And it is that's where people like you come into the picture, of course, because the stories you hear of people saying, I couldn't get a mortgage for love nor money on this. I went everywhere. And then you bump into somebody else, no problem at all.
Yeah.
Finding the right person. I mean, they are out there somewhere, right?
Yeah, I think that's the interesting thing about the market, that the specialist lenders and the specialist brokers.
Yeah.
And what may well be the impossible or be perceived as specialist to a high street estate agent bank type mortgage advisor rather than a specialist broker. What is mainstream for us might be specialist for somebody else.
Sure.
So there's access to the lenders, knowledge of the number of lenders in the market. And I think there was a really interesting stat on how many products were out in the market of October 22 when we had the quasi-quarantine budget. There was kind of 6,000 mortgage products.
That was a great budget, wasn't it?
Oh,
hey, we all remember that.
We've moved on though, haven't we?
Good old Quasi. Played an absolute blinder there,
moved
didn't
on.
he? Yeah.
Not scarred.
Everything was tickety-boo after that.
But there was roughly kind of 6,000 products that were drawn from the market in a week.
Wow.
And someone told me the other day there's sort of 24,000 products on the market at the moment.
Yeah.
So the need for kind of specialist advice is high.
Yes. I would imagine it is. And I mean, just to come to those that are looking at, and I would suggest that lots of our viewers to this on a weekly basis are portfolio landlords. Again, it's another area where many, because of instability, what is happening more, not just in this country, more generally with the financial markets, there is a sort of volatility there. There's also a danger you can talk yourself into volatility as well. When people say, when's the best time to buy a house? A lot of people say today, because you will always find different circumstances that could preclude you from doing it. But has there been a noticeable drop or spike in those looking to increase portfolios?
So we did a fairly rudimentary poll at the recent Landlord show, and sort of 5% of people were selling. They weren't selling up, they were selling. And I think what they're doing is rebalancing. They're looking at their lower yielding properties, the ones that they might need to spend money on, the ones that may not meet the EPC, and thinking, I don't want those in my portfolio anymore. They're too much hassle. There was about 25% that were buying this year.
Yep. And
the danger is it's the 70% that are sitting on their hands at the moment, waiting for everything to settle down. But what we're seeing is those that are rebalancing their portfolios and getting rid of their lower yielding ones are looking at where they can invest and what they can invest in to diversify. So we're seeing the landlords not just looking at their single units or even their multi-units and freehold blocks. They're going, well, actually, should I have some semi-commercial in there? Should I start to take some short-term finance and get some under-market or auction properties, refurbish them, put them back on and turn them out on a buy-to-let deal? So we're seeing landlords now going, well, what else can I do to make this work?
Yeah.
And what other markets should I be in? I think if you look at COVID as an example, and if you've got all your eggs in one basket and that basket's suddenly not viable.
Yeah.
And actually, what it's done is potentially look at the high street and think, well, that needs to be repurposed. There's opportunity there. You're seeing lots of the big retailers come out of high streets, independents going in there, and they've got retail units above them.
Yeah.
So there is potential for lots of portfolio landlords to go, well, what else can I do and what can I do differently? And that's what we're seeing with our client base. They're thinking about it slightly differently now.
Yeah. And I've heard lots of people say, well, actually, the only way to really succeed in this world is to have a good portfolio and to expand it. And for some people, that in itself is the criteria.
Yeah, and I think the other thing that we've seen is our larger, more professional landlords are still buying.
Mm.
So, there's lots of, a year ago, everyone was, it's the death of buy-to-let and it's the end of buy-to-let and everyone's selling.
Yeah.
And the reality of that is, buy-to-let took off in 1998. Lots of people did sell in 23 and 24 because they'd had their mortgage for 25 years.
Yeah.
They're 25 years older and they are allowed to retire.
Yes.
And they did.
Yeah, the whole purpose of doing what they were doing was come to fruition at that point.
Yeah.
So.
But the professional landlords that are currently active are remaining active. And that's the positive thing that we know.
Yeah.
There will be pent-up demand for those that are currently not doing anything, waiting for regulation, legislation to settle down and then go, right, well, this is the landscape we can now operate in. But landlords can deal with certainty, whether that's increased rates or decreased rents or whatever it may well be. They can, if they got certainty, they can deal with it, not knowing what the new landscape may look like or what the renters' rights bill may well look like in its entirety when it lands.
Sure.
Or how the EPCs or home energies might land. If you don't know, you can't operate.
Yeah.
So I think that's the kind of biggest concern for the less professional landlords where, one property is 25% of their portfolio. You can't get it wrong.
Yeah. Give us a word on, in fact, we'd be failing if we didn't mention green mortgages. I mean, if somebody had said to you a couple of years ago, can I get a green mortgage?
Yeah.
I'm not suggesting that's the official title, by the way, but folk would have thought you'd gone a bit, Matt, what does he mean about green mortgage? But of course, there's no part of society at the moment that isn't touched by Ed Miliband's green revolution.
Yeah.
He's loving every moment of it, but I'm sure this factors in to this world as well.
I mean, lenders are looking to incentivize landlords or borrowers to upgrade their properties, to meet energy efficiency. And that's the challenge because they don't know what that's actually going to look like, but actually improve their properties to be as energy efficient as possible, incentivizing those by giving them preferential mortgage rates or even stepped mortgage rates. So once they get to the right, great. That's fantastic. But lenders can't give it away for free. So they might be incentivizing and discounting that area, but they're making that margin somewhere else.
Right, gotcha.
So, yes, there are incentives. Yes, there are opportunities. Yes, you'll get a better rate if you've got a better property.
Got it. But are you looked at more favourably, just instinctivly, if you say, I'm buying a house and it's got loads of solar panels on it and a big old windmill on my roof? Is that likely to, are the lenders going to go, you seem like a jolly nice chap because you care about stuff. Here's some money.
I think if the property is an A, B or C and it's comfortably A and it meets all those requirements, then yes, it's a good property.
Got it.
And it's low risk. The solar panels is a different matter altogether because of the way that they're leased and so on and so forth. But reality, a good property with a good EPC rating, lenders aren't going to be perturbed.
Okay.
If it's a D or an E or an S, then
you might be in a slightly different situation.
You might not get access to every lender.
So just finally, Gavin, give us a bit of an overview out there. What is it looking like? 2025, most of the year is still ahead of us.
Yep.
Lots of changes are coming in. In summary, how is it looking in that world? What would you say to potential investors?
I think we're, I'd like to say over the worst of it. I think if you kind of started this year, everyone was excited about rates are going to come tumbling down.
Yeah.
And I remember reading articles by HSBC and PwC and people like that saying we would have base rate at 2.5% at the end of this year. Not a chance, I'm afraid. I would love to say that's going to be the right landscape for us. Reality, I think we'll probably get 2 further base rate reductions this year. I think they'll be towards the end of this year. I think mortgage rates will probably start to react in a similar sort of fall, bearing in mind that lenders fund differently and balance sheet lenders can fund it in correlation to base rate, but specialist lenders might not be able to. Lots of it would depend on sentiment and political sentiment and inflation and all these types of things. I don't think that's going to be pretty for the next 3 months. I think we're going to see a spike in inflation, probably more so after tomorrow's announcements or statements.
As we record this, of course, it's the spring statement tomorrow.
So I think a lot of the commentary there might be inflationary.
Yeah.
which I think lenders pricing might start. We've already seen lenders pull rates today.
Yeah.
In kind of almost in, the market's reacting to what they're expecting. And so but I still think we'll get a softening of mortgage rates towards the end of the year. I think we'll probably finish the year at kind of 4%, which means mortgage rates will probably be around 4.5 to 4.75 for sort of buy to let. And I don't think we'll see huge reductions the following year. I think we'll probably still see 26 similarly around 4, maybe down 3.75. It'll be great to end 26 at 3.5. And I think when we do get there, that's the new norm. Yeah. That's where it'll settle.
It's not going to be 1, we can say that.
Unfortunately, we're not going to go back to the rates we've had.
No.
Probably, so I think the new norm will settle around 3.5%.
Okay.
I think lenders are on board. Lenders want to lend. They've got the criteria. They're constantly looking at, we can't innovate because there are parameters. So lenders are always looking at how they can support the landlord. Sure. And they are lobbying as well to support landlords around EPCs for political reasons. So I think it will settle down.
Yep.
And I think there's pent-up demand from the landlords. And I think criteria, rates will all come back in and the market will slightly just contract a little bit and then move on.
There's good news. There is. We said there's good news. Gavin, great to see you.
Yeah, thank you very much.
Gavin Richardson with us on the programme. And Tracy, back to you.
If you want to stay up to date with the latest UK property news, make sure that you like and subscribe to our channel.